And welcome to tonight's webinar. We're going to discuss price action. My name is Mike Rotting. So before we get into the actual webinar, let's take a look at the risk disclaimer first. As always, I'll give you all a minute to read through that. Yeah, I think that's long enough. All right, so what are we going to discuss today? Well, first of all, I'll introduce myself for the ones that are new, that don't know me, and then we'll skip right into basically just finding a little bit what price action really is. And today we're going to be covering, with support obviously of our chart, we're going to look at price action in specific candlestick formation, so that part of price action. We're going to also look at chart development, so different patterns that develop during the chart. Then we're going to discuss how to actually implement it. And obviously, as always, at the end of the hour, we're going to have a Q&A that will last as long as it lasts. So yeah, let's get straight into it. So first of all, who am I? Well, my name is Mike Rotting. I'm 36. Originally from the Netherlands. I studied international business studies there. Eventually, boy meets girl. Boy moves to Greece, and married, have a kid, wonderful daughter. And it's been a roller coaster. It's been fun. But what do I do? Well, during my time in the international business studies, I was a little bit bored. So I started looking at what back then was known as binary options. It was kind of being tested around. As we all know, binary options has a few flaws. So I switched to Forex over time. Whereas most people, the first 2 or 3 accounts, didn't do too well, followed 100 different gurus and YouTube videos, and tried to figure a whole bunch of stuff out and copy everything that I could hear, but none of it seemed to work. So eventually I just threw everything out the window and basically started from scratch and really started learning step by step. And basically from the 3rd year of trading, I have been yearly profitable on a yearly basis. Which brings me to down the line. I obviously work for a few brokers around the line. Ended up working for myself, do some mentorship, and right now I am more involved into the financial services industry in the sense that I'm trying to obtain my diplomas for wealth manager so I can look into different types of investments like multi-fund asset management and offshore investments in these kind of vehicles. And I still obviously dabble with my own retail trading, but not nearly as intense as I used to do. That's me in a nutshell. So let's discuss about what price action actually is. So first of all, people think it's a strategy. It's not. It's a technique, and it is actually just a trading technique that allows you to read the current market based on recent price movement and speculation. And this is a very key essential point to keep in mind, right? Price action is speculative. It is by no means something that is written in stone. Is like, hey, it's going to happen. There's no such thing. There's not a single strategy out there that is 100% guaranteed. You always have to keep that in the back of your mind. There are some things that when you combine them will give you a damn good accuracy rating though. And what this trading technique, what price action allows you to do is basically make a suggestive trading decision based on those current price movements. So what you need to keep in mind is that price action doesn't care about fundamentals, right? When you look at development of charts, this is not a fundamental based thing. However, it's dependent on technical analysis because on its own, it's not enough. As most other things as well, on its own, it's not enough. You always need more support. And this is how you build different aspects together. one of the other great benefits that price action really has is that it's applicable over many different securities. Now, in some cases, when we discuss, like, let's say, indicators, some of them are good for Forex, some of them good for CFDs, some of them are good for commodities, some of them mix, but it's very rare, like they really combine everything. Price action, however, is, because it's basically sentiment of market, is applicable in almost every single aspect. So whether you're trading assets like Forex assets, or if you're trading CFDs or straight up stock, price action applies, because it's basically the reaction of traders in the market. And it is something you need to be careful with, because if we look at, let's say, a trading frame, this is more something for short and medium term trading. And when you read about price action, like, hey, this strategy is amazing, look at the results, et cetera, et cetera. Price action, when you do look it up and try to find different aspects, you need to be careful, because it suffers from something that we call, it's a bias. It's basically survivalist bias. Basically, it means that the only ones that ever get represented in the actual media come from something called, the success stories, but nobody talks about where it went wrong. So, and as I mentioned at the start, because you say it's subjective, right? Every trader sees price action differently, and they read the situation differently. But the benefit of it is it makes it extremely flexible to fit in any strategy, or fix with any trading robot, or fix with any other aspect that you might be doing, because it's so malleable. There's few key points that you look at, and then you can mold it into, okay, I ignore these, but I accept those, right? So this allows you to really put it over a broad spectrum. Now, there's a lot of different ones, and we're going to go through them one by one. Not all of them, obviously, but we'll grab a good set. So in synopsis, price action is literally the current price move, the recent price movement based on price and momentum, and gives you a good idea of how a market develops. Now, when we do the technical aspect that supports your price action decision making, we don't look further back than, let's say, 6 months. Because the price action that was, let's say, a year ago or 5 years ago has nothing to do with the price action that you're looking at now. The key elements are still going to be similar, but you need to keep in mind that you're reviewing the recent price, not a long-term 5-year trading plan. Us simple retail traders don't trade those periods of time anyway. We're not doing structured notes, right? We're not doing a treasury yield bond for 10 years. We're doing short-term trades, medium short, right? So let's look at some candle formations. Now, the first one, everybody hears about it, but Doji. Now, Doji comes in 3 different forms. But keep in mind that on its own, Doji doesn't tell you anything. Doji is actually a neutral kind of signal. Anybody happen to know what Doji stands for in Chinese, in Japanese? Because it's originally from Japan. Anybody happen to know what it stands for? No? All right. Nobody has. So Doji actually in Japanese means mistake or blunder, which is kind of funny, because when we look at the 3 different versions, we have the Greystone Doji, the long-legged Doji, and we have a Dragonfly Doji. Now, don't worry, we're going to look into the chart in a second. And we're going to do it actually right now. Oop. So there's a lot of different ones, but let's go find a Doji first. So right off the bat, we can already find one. So for instance, here this would be a long-legged doji. The opening and closing price is almost identical or identical. So like this one, right? But as you can see, on its own, it doesn't say anything. There needs to be a combination of things for this to work. For instance, here, it would have worked if this was engulfed, but it's not, right? It's immediately being reversed. So let's try to find another scenario where we have a gravestone, probably one, like here. This would basically be a gravestone. It's kind of like a sword, right? You have basically a cross upside down. And then dragonfly is when you flip this one the other way around. All right, makes sense? Now, what they generally indicate is a potential reversal, but it's, like I said, on their own, it's not enough because you get them all the time. It doesn't mean something is going to happen. Like we have one here that something happened. No, it just went sideways. Here we have a good dragonfly. And it says like, okay, look, I'm going to turn. It kind of did, but not really. Now you can combine that because you have different price action signals in different areas. Right here, we have a very big doji, right? Looking at a gravestone doji here. But it's combination of, usually it's a set of 3. Most candlestick patterns are a set of 3. So that's what a doji looks like. Now, the reason that we cover doji first is that although on its own it doesn't do much, it's usually part of the following. And the first one is something called a harami cross. Now, harami cross is a consecutive buildup. And we're going to go find one together. So basically, a harami cross will look like, if you're going up, it would be 3 candles up or 4, doesn't matter, and then a doji candle. But the doji candle must be contained within the previous candle. And that's usually a sign of possible reversal, right? So for instance, here, we got 3 up and then a doji. Is this contained within? No, it's not. The pattern price action we get here is actually a double top, but we'll get back to that later. So there's different price actions that trigger a potential reversal, but this was a sign that it was potentially coming that later got confirmed by this in combination with a pattern, right? So if we, I found most of them. I couldn't find one of these real fast. So just bear with me here for 1 second. Come on, should be one here. No. This is for later. This is a good example. Yeah, this will count. So here we have, for instance, harami cross, where you have 3 down and this one slightly out of, but it's basically contained within. Here we have a very, very small doji after basically double down, which is contained within its own previous candle. So it indicates I'm going to turn the other way. Now, as you can see, these are very short-term signals and they flip a lot of times. If you go to a bigger time frame, let's say a week, right, you're going to have less signals, but when they do happen, they matter, right? Because the bigger the time frame, the more sensitive it is to market sentiment, to bigger, it's slower moving. So that means it's not going to change direction, that fast. It usually holds for from a few weeks to a few months. Okay. So if I would take an isolated point, what is not exactly what we're looking for, but it will help. Objects, I just need a box. Okay, there you go. So if we would have this, if we would have this, okay, ignore that one. If we would have this being green and these two being green and that one red, that would be a Rami cross. Except here we have something else, engulf. Right, so that's what that would look like. Well, and that works both ways, right? So if you have 3 green up and then a doji formation, it'll either be a gravestone or a long-legged, usually you're going to get usually you're going to get a dragonfly or a gravestone doji because you're either having a bearish or a bullish movement, right? So the time that you get a long-legged doji, so basically literally a cross, is when you have like a gap opening. So that would be a Friday close and a Monday opening. Well, technically Sunday, but that's when you would see that pattern involve. Yes, this also works on, let's say, 4 hours and hours and stuff like that. But like I said, the bigger the time frame, the more stable this is. So when you're looking at very short time trade framing, short-term trading on small time frames, let's say a minute, you're going to have to make your decision really fast, which means that you need to first practice slowly on identifying how these patterns develop and what their trigger numbers are. So what is the trigger that it needs in order to actually continue, so you don't buy into false signals, right? This is more for the people that trade, really short term, like 15 minutes and stuff like that. Most of you, especially if you're a beginner, trade an hour or 4 hours. Day trading is, stay within that 48-hour trades, and build it up. But that's where these, Harami cross, you're going to see them in the 1 hour and 4 hour more often, and they will help you make your decision on whether I should keep my long trade, right? For let's say we see a bullish Harami cross, and we want to take a long, right? Then this would be like a possible scenario where you could go like, okay, I can take this. Now, where's the nearest resistance for this? And I will take the stop loss underneath that. Or if I want to take it really short and I'm not so sure and I want to be a bit more risky, or you're already in a long position and it shows you indicating it could potentially reverse now, is you move your stop loss into the green underneath the shadow of the last candle or the wick, right? So that if it does reverse, at least you secure whatever profit you have up to that point without having to tight, right? So this is a decision of micromanagement between, do I take the average daily range or do I take the candle pattern? This is why it's very subjective, right? It depends on what your decision is, what you want to do. I would make different decisions than you. It's that simple, right? And sometimes I'm wrong and sometimes you're wrong. And sometimes I'm right and sometimes you're right. But that doesn't matter. At the end of the day, if you do everything right, it doesn't matter who's right or wrong, because you only need to be right 40% of the time. So another one that we see a lot is something called an evening and a morning star. Now they're generally a combination, they're a combination of 3 candles, and we actually have them quite often. So, come here, where are you at? Oop, there we go. So this right here, can we get the box thing again? Whoops. There you go. No, graphical shape box. There you go. This set of 3 right here, this combination of down, down, up, that's a morning star. So we're going up, it's pulling down. Now, if this was, as you can see, you have your technical indicator here, right? So this is your resistance line, because, support line actually, resistance here, support here. You have your uptrend. It broke through what is then the resistance. It reversed, right? Big engulfing candle, reversed. 1, boom, it hit the support line now because we're trying to keep going up. And on the next day, it started creating this candle. Now, the rule is for both morning and evening star, these two need to be entirely engulfed by the third one. Once this session closes where it was, that's your confirmation that this is going to go the other way again. Obviously, again, not always, but you actually have a double confirmation, because first, this and this candle, these two, got into the range of the resistance, and this one tried as well. All three did not get through the resistance line, or the support line, sorry. Sorry, because my eyes are here, so it's like resistance here, it's support here. So on this support line, it bounced off 3 times and created a price action candle confirmation. So now that's all you need to know. All right, so we can go in. Now, how far did it continue? Well, it's still growing, right? If you would even go in late here, stop loss here, right? Stop loss is underneath the green line, underneath this line here, right? Underneath the shadows. So you would be somewhere here. If you were safe, you go here, but probably this is fine. Then you have, this is your stop loss, and now you just need to judge, where is my take profit going to be? Well, in this case, you would have probably taken the wick of the previous set as take profit 2, and take profit 1 would have been in top. So that would have been what? Like 90 to 100, which wouldn't be optimal. 170 would be better. That's almost 1 to 2. That's okay. But, you know, perfect scenario, we're not always going to get exactly what we want. So we have that pattern here, and here we see like it almost looks like an inverted version of it. This is not a signal thing. This does not count, right? If this one was red, yes. It's not though, right? So if we find it the other way around, like here, this is actually something else. In this case, you just bounce off of the resistance here, but moving upwards, we can find more. They are actually quite often pretty common. Like here, up, up, red, and we go down, but it didn't stay down because immediately you got this bastard, right? And you had your decision-making tool, because apart from this line, you just came from, hey, come here. You just came from this resistance. You just broke that resistance, so that turned into a support, and it bounced off of that. Now, it did shift a little bit, but not a whole lot. Right? Remember, resistances and supports are ranges. They're not exactly a flat line. So let's try to find another one really fast. One that's nice, that really shows you exactly what you need to be looking for. So we're looking for double red to green, a double, yeah, well, yeah, no, too big of a shadow. But as you can see, they happen quite often. And now I'm looking on a day. If you were look on a smaller time frame, it counts exactly the same. It doesn't matter. It really doesn't. Okay, so you want basically a big candle into a small candle, like I showed. Come here. This big, small, big. But this one needs to cover both candles, right? So when you invert it, same rule, right? Double greens. So this one, but it should be flipped, because you can only have it when it goes up, but we don't have any up in this scenario. Well, this one almost, but not really. Right, so that would be a very strong signal of, hey, no, I am turning away from this line. I am going back up, or I am going back down. Right, which would sometimes help you indicate before a breakout. Because if it happens on a key resistance line, right, so you're going up, it's coming back down, right, and it's giving you, and it's coming up and it bounces off of this line. It gives you the key resistance all the way in the top, the highest point it's been, and it forms this formation over the next 3 days. Then on the third day, when that day closes, you know that highly likely the uptrend's over. it's now going to pull back, it's going to reset. So if you would combine this with something like Fibonacci or an RSI to help you make the decision on momentum and overbought and oversold and all that kind of stuff, you add all these technical layers to it, now you have your confirmation. Okay, so that's an evening star and a morning star. So this is a good example of a morning star. What's the next one? So pin bars. So pin bars are actually really interesting because they actually help you. People will see them a lot during news announcements where you have this massive candle shooting up and then it yanks all the way back down by the end of the candle duration. So whether it's an hour, 4-hour day, doesn't matter. But what happens is that this pin bar indicates that, yes, there was a reason for me to go up or down there, but the market sentiment is like, nah, it's just no. I pull back, everybody close the position. So all those, if we're going down, all the short positions, nah, we closed it, or at least enough volume to pull it all the way back. Don't mistake it. Right, it could be part of a doji. It doesn't have to be a doji. Right. So for instance, here you have a very big pin bar, which is also a doji formation. Right, but this is a pin bar. The pin bar goes through the support or resistance. So this is a very, very good example of a pin bar. Right, we're going up, we get this massive pin bar. If it wanted to continue back to the previous high, this should have closed above, but it did not. And what did it do? It flushed all the way back down. Right? So that is one. So let's find another scenario where we have this. Where's another nice pin bar? So no, it's not really a pin bar. This would be a pin bar in a sense, but not really, because this is a gap opening, because this one opened here and it closed there. So this was a Friday. So this was probably more a correction of the market. But here, for instance, where did I just see it? Where did I have it? Oh, here's another morning star, by the way. Pin bars, pin bars. This is a pin bar right here. Again, it's the same as a doji, but the pin bar is, the key is that it's on a resistance line, right? So it's piercing a resistance line or a support line. And the best scenario you have is this one. We're back at this guy again, where we have this resistance right here that did shift a little bit, because it used to be up here in 2018, but now in 2000, in the end of 2000, this is January, this is September. So a few months later, it shifted a little bit, and that had to do with obviously this. So if we go to a line chart, it's a bit wonky because there's a lot of static noise. But if we put it on here and switch it back, this is where that pin bar comes in. So it went up, tried to go up, got rejected, tried again, got rejected, tried again, didn't make it, tried again, got rejected. All right, that's all the signal you need to go down, basically. Here's an extremely good example of a pin bar, right? So the resistance would have been a little bit harder to tell here, because you would have had to extrapolate it from the past, probably. I think it would be somewhere over here, I think. Which is generally what you don't have to do, but sometimes you will have to do little funky tricks. Sometimes you just can't guess the line and you have to wing it a little bit, right? But in essence, right, pin bar, this is like the perfect example. You have upward movement, try to push through, really big spike through, closes underneath the resistance, however, ergo, we flip the other way around. This is your call sign right there. That's your go. The second the next day starts developing red, you just take your sell. And obviously you take your stop loss above this, above the shadow, and then your take profit would have probably been somewhere like either here or for those that are a little bit braver, you would go for the next resistance based on the previous past. Engulfing candles, I think, is the most common one that people know. Here's the thing. Engulfing candles where people go wrong. There's always a little bit that debate of, this is an engulfing candle. It completely covers the previous candle in the opposite direction, right? So we go down here and it completely smothers the previous candle. That is a proper engulfing candle. This, however, is not a proper engulfing candle, but it still moved up, except it didn't continue onwards. This one continued onwards much longer than this one did. Now, here's the thing. There's always this debate of, does it need to completely cover, yes or no? The answer is not entirely. I would say if it reaches like 85%, 85%, that's enough, because that's enough reversal pressure for it to carry on. Now the question is, how much is that going to carry on? And you can see here, it just bounced back to the resistance, right? So here, do we have an engulfing candle here, for instance? No, we don't. So it did pull back a little bit, but not nearly enough. Here, however, right, this candle completely covers top to bottom. The shadow is actually longer with the shadow. It's longer than this candle combined. So it is an engulfing candle, and that one definitely went down. Right, so the benefit of price action as well is it's really easy back testable. You can literally just go through your charts and see what does it do when. Right? So for instance, here we have a small engulfing candle. We go down, 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 down more, up enough, and then the next one just develops up. Now you might think it's not a lot, but if you would go in on the second day, your stop loss is underneath the shadow, and you would just go back to the resistance, right? That is 60 to 60. It's 1 to 1, 60, 120, 1 to 2. Fine. It's not perfect. You prefer 1 to 3, but we don't live in a perfect world, so forget about it. You're not going to get that all the time, as much as you want it. This obviously is like I don't know how much more of an example you want. Literally jumped, skyrocketed. This is March, obviously last year, but this is the perfect example why price action doesn't care about fundamentals. The price action was massive upspurt, right? This was the whole time, the COVID thing in March. So the second that this opened and it slammed, that just literally gobbled up this candle. This is not just I'm setting back a little bit. This is I'm going to go all the way back down, which is exactly what it did. Right? And you can just take a chart, any chart you want, and just start doing this, and you will see the same thing over and over. So here we have a nice combination of a double top with price action of, we have that doji that we talked about earlier. Then you had this, and then the engulfing candle on top of it, and a retest. Yeah, gosh, we go down. Here's another example of a pin bar. Right, down, 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 tried all the way down, pulled back in, went a little bit up, and it went up after that. So you could have made a small trade there. Right, so there's signals all over the place. The question is, which one are you going to follow and which one are you not going to follow? And this is why technical analysis as a tool on top of it is so important. On their own, price action is not enough. You need something to see what level is it at, where the market. So for instance, like an RSI to tell you, hey, this Morningstar, for instance, like over here, is happening when it's oversold. So not only is it oversold, I now also have price action confirmation that it wants to turn. And then you can combine that with and I have my resistance or my support here telling me that it's not going to go anywhere. because it already got rejected twice. So this is how you build up several different confirmations of, hey, this is about to probably happen. And I say probably because you're still going to get nailed from time to time where you're going to hit your stop loss, right? But if that is the exception instead of the rule, you should be fine on a yearly basis. You don't have to win every trade you trade, right? 40% is all you need with a proper risk management. If if you then do your trades right, you will automatically trade better than 50%, which means we're with the same risk management that's profitable in 40%, obviously in 60%, it's even more profitable. You don't need an 80% win rate. Complete nonsense. Right? This is for signal traders that just care about getting a lot of followers. Social trading. Now we have talked about some of the candlestick formations. There's way more. Obviously, we don't have time to go into all of them, but there's another aspect of price action we need to combine with this. And that's chart development. So the first one I want to discuss is something called a double top. Now we all know the double top. It basically looks like an M. We don't all know. Some of you are here to learn. It looks like an M, and a double bottom looks like a W. But you can also get a false signal where it looks like a double top, but it's not, or a double bottom. The key point in a double top or double bottom, it has to test the resistance or the resistance twice. It has to actually touch it. If it doesn't, it does not count. Right? So I think this one, no, that's the head and shoulders. There you go. So here's a good example of a double top. Why is this so weird? Oh, okay. So this double top, right? We go up from an uptrend here, and we turn here. We have this engulfing candle. We don't have this line back then. But yeah, it's because you're in an all-time high. So we pull back and we bounce off of this resistance. All right, so we go back up. Did it test it here? No. This is not a double top. It didn't test it. It didn't touch it. Pulled back, pulled sideways, and eventually went up. And here, when you get the second candle to close, so day one, day two, you automatically create this resistance. The second that this day closes here, you have two candles closed, and there you go. Boom. Now you have your confirmation of your double top. It tested it twice. There's a little bit of a rebalance in there. And now, even though it did retry, bomb. And it kept going and going until, is that a double bottom? No, it's not. It's a double top though. So this one indicated down, down again, but it didn't quite reach it. Now in this case, it still pulled back up, but generally speaking, it doesn't. This is not clear enough of a signal for you to take this the other way, right? Because there's enough reasons for it to just continue downwards instead. This is where the other tools come in effect again, where you look at what do I have, where are we at, right? So again, it's not enough on its own. This is a false one. It's not a double bottom. This is not a double top, right? Up, down, up, but didn't touch it. Not even the shadow touched it. Now you can start doing this, like, well, if I squeeze it, yeah, there you go. Now it touches it. Yeah, now you're just, lying to yourself, right? So you have some confirmation here. You could say here as well, which is, touching here, and then you pull it all. It's still valid now, apparently. Oh, we're not in now. We're way out from now, but that was for an example. Where's the double top? Where did we go? Why did I do that? And here we go. right? So this is what a proper double top looks like. Test, retest. So breaks the resistance, goes up, bounces off, so turns, comes back all the way back down to what is now the support, bounces off of it as it should, almost creates a harami cross here, by the way. Up, 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 but not entirely. The candle's a little bit out. For harami cross to be valid in this case, this candle should not have had a shadow higher than that, and this price should have closed closer to each other. Because this candle's length is almost the same as this candle's length. It needs to be smaller, and it needs to be inside here, which it's not. It needs to stay inside this area. So we found our harami cross, a bit late, but still. So here we have a test. It broke several times, gone down, retest the support, goes back up, false signal, goes up, bounces off one, bounces off twice, pin bar. All right, Bob's your uncle, go in. The second that this line pulled back under, basically you would have gone in here. This one you might have been getting nailed because if you put the stop loss too tight, you would have gotten hit by this one, which is one of those scenarios that I talked about. It's not perfect. But this could have been a news announcement or something that caused that influx of buy. So always check, standard rules before you open a trade. Is there any news announcement in the next 24 hours that can screw me over? Right? Or can mess with my trade or the momentum or flip it or anything like that. So that's where, you can avoid this, and you would basically go in once it pulls back, which is probably end of the day. The next one we're going to discuss is head and shoulders. Now, head and shoulders is actually not that common. Right here. So here's a good example. This is the pound Swiss franc. We're moving up here, right? So we're in a slight uptrend that starts to accelerate. We bounce off, we turn here, we go back down, turn back up, break through this resistance. Bounce off, create a top, right? A new high. So at this point, we're doing this. Right, so at this point, we're accelerating, we're creating some momentum, but we're not quite there yet. We bounce off, we create a new stable horizontal level. Whoops. Go back down. We bounce off of this, go down. Now here, you don't have to retest, but it needs to go through and test this part again. Right, we're not dealing with a double top. In this case, we're dealing with a head and shoulders, and these two need to be equal to each other. And there needs to be a clear head, not like this one is over here and these two are over here. Then you have like a small triangle that doesn't count. It needs to actually be like a little peak. Then you get another shoulder, and that shoulder rejection is usually your go moment. So if you've been waiting all this time, this is your go moment. Swing traders go in here, you go in here. And then you would have probably said, okay, hold it till here, stop loss is 0 once it reach here, once it break through. Your take profit would have obviously been somewhere around here, which is the lowest resistance. You would have just missed it, it would have gone up and you would have hit it here. So you either micromanage, close it here, or you wait for it to get there. Anyway, different thing. Right? But that's how I think. That's how my mind works. Right? So we go up, go down. So this is a perfect example of a head and shoulders, what it looks like. I'll take these two out. This is the point you're looking for. A, B, C. Which is more predominant in smaller time frames. You're not going to see it in day that much. Same as triple top and triple bottom. It's very rare in higher time frames. It happens a bit more often in lower time frames, but the rules apply the same, right? Now, there's one more that we can cover before we go into the next part, and that is the cup and handle. So this is the one that's not that well known. and it actually isn't that commonly used. But this is what the cup and handle actually is. So you have like this U-shaped bend into something, and then you start getting this high is higher than this high, right? But then the next high is lower. So if you would take these two candles as a key point, you can put this line on there, right? So if you would do, let's say, shadows only, you would have something like I'm looking at these candles, obviously. So you would extrapolate it like this. And then you have your bottom candles where you're, we only had that at the time. So you would use this and this and extrapolate it over those lines. Now here you have, when is the first candle that confirmed gets outside? You have your cup here. So it should never close underneath that line anymore. The second it goes out of this pennant, you go out. Now, sometimes you have a very predominant cup, like a very big U shape. And then it like has like this little lib and pulls back down. So almost like a little swirl handle, right? Like an S shape. And then it kind of moves. And this is kind of a consolidation phase turning into a breakout. But you don't know which way the breakout is going to be. Well, this tells you which way it's going to be, because whichever side it closes outside of first is the direction it's actually going to go afterwards. This is kind of how the market sentiment works. And remember, you're talking about sentiment, you're talking about trader sentiment. So this is very, very subjective. So always be careful when, consider all other factors as well, not just, oh, wow, I see this, so that's going to do this, right? That's basically in essence it. But now that you know all this, how do you use it? Well, there's a few steps to it. So first of all, as it's reliant on your technical tools, you do your technical analysis first. Top-down analysis as usual, right? Start at your highest time frame you start with and work your way down. Now, and don't do more than 3 different time frames, please, because otherwise you're going to have so many lines on your chart, you don't even know what the chart is anymore. Then, once you've set up your technical analysis, so your indicators, your support resistance, your trend lines, you name it. The next step is you wait for whatever time frame you in, you wait for the candle to finish. Never assume an active candle is going to give you that price action confirmation until it actually gave it to you. So often I see people just, oh, look, it's creating this. Yeah, it is. And then they open the trade. I'm like, what are you doing? Yeah, well, it's making a morning star. Okay, did the candle finish the third one? No, then it's not a morning star yet. And quite often it will pull in and it become a pin bar and it goes the other direction instead. Like, oh, if you would have waited, you would have seen it. Right? Patience is key. Don't be a wait to play the waiting game. Right? You're not a social trader or anything like that. You don't need to make 100 trades a month. If you make 4 winning trades, it's much better than 100 losing trades. Or break even, 50 up, 50 down, right? Step 3, identify the possible price action. So, when the candle is finished, then you can identify, what am I looking at? Is it morning star? Is it a Harimi cross? Is it just a standalone doji? Is it an engulfing candle? Is it a pin bar, a hammer? What else do we have? So many different ones. All right, so keep that in your mind, right? Then you need to apply your trading strategy, or in essence, the rules, right? You go through your whole process. Once you have your trading strategy, you go through the rules, the what if, which is basically a rule of elimination before you open your trades. Now, before all of this, you've obviously already, before that, step 4, in that trading, you initiate, or in step 5, you initiate or abandon the trade after determining, obviously, with your strategy, what the stop loss is and lot size and all that. Right? So your accepted risk ratio should be in there. Your stop loss, your take profit should be in there. Your lot size or goal should be in there. Your projected time frame you're going to keep the trade, etc., etc. Your exit strategy, you name it. Then you initiate or abandon the trade. It's okay to sometimes just let go and walk away. If you're not sure, don't take the trade. There is so many things to trade. There is no way in hell you can't find one. There's always a trade somewhere. Just because you've only been looking at euro, US dollar, pound dollar, and the New Zealand dollar doesn't mean that on all the other pairs there's something. Yes, I know for a smaller account, you shouldn't be trading CFDs or commodities or exotics. But just the majors and the minors alone should pretty much fill your portfolio with trades. There's no way that you can't find a trade. And what's the big deal? Let's say you can't find a trade all day. There's nothing to be found for a week. You also haven't lost money for a week, waiting for the right moment to actually take a trade that's there instead of trying to make a trade happen that's not there, and end up losing money because you're impatient. One of the big mistakes I used to make. Then obviously the last step is very simple. You manage your trade, you monitor it, you keep an eye on it. Now, don't micromanagement in the sense that you bring an iPhone or a phone everywhere where you go and you keep your eyes glued to the screen. It's up a pip, it's down a pip, it's up a pip, it's down a pip. Don't do that. You have a stop loss. Always. You have a take profit. You should also have a set trailing stop to trigger at some point. You know the daily range. What you're looking for is any weird fluctuations that might occur, so you need to intervene. You look at the development in the morning, midday, evening, 3 times a day, you just check it. Now, if you're trading a very small time frame, let's say you're trading on a minute, obviously you're monitoring it for the 10 minutes that you're trading it, because you're trading it for 10 candles. When you trade a day, you trade 10, you can trade up to 10 days, maybe 2 weeks. Very rarely is you're going to trade going to continue on for a month. Most of our trades are 48 hours, sometimes a week. And if you're 3 days into the trade and it's basically still at your entry point, now you've married your position. If you refuse to close it, this is what we call marrying your position. So you just won't accept the fact that it's not doing anything. Get rid of the damn thing and replace it with something else. Use the equity for something else. Replace it. There's better trades out there. That is basically price action in a nutshell. Obviously, there's way more to this than just what I covered today, but at least from a starting point, this should help you out. Having that said, that basically covers the theoretical side of today's webinar. So for those that are leaving, I would like to thank you all for listening. I hope that you learned something. I hope it was you enjoyed the webinar. Usually there's a survey at the next day, or that's completely anonymous. Jesus. So much appreciated if you can fill that in, because it gives you the chance to give some feedback about what the presentation was like, what I was like, the quality, etc., suggestions, you name it. Okay, so thank you all, and thanks for listening.